Hey everybody, this is Jack Allwell with another money episode, and today we are discussing the 40-year mortgage. So let's get to it. Looks like the FHA is increasing the term limit from 360 months or 30 years to 480 months or 40 years. I mean, this lowers the payment. However, the amount of interest you'll pay is a lot more, but let's take a look at what that actually might be. So you may have seen me play with this a little bit. This was a worksheet that I made, and I'll put a link to it in the description. This is being sold on Etsy, but it basically allows you to visualize the balance of any loan and how much you're paying each month in interest and principal. And that in table form is here, and then in graph form is here. Let's do, and these numbers look a little old. So $400,000, $40,000 down. Okay, so you can see the balance starts at $360,000, goes to zero at the end of the period. So let's first look at, so if you would have gotten this in the beginning or the middle of the pandemic, let's just say 3.5%. Okay, so the payment per period is the $1,616.56, and then the total interest paid over that period is $222, almost $2,000. So actually, let's keep track of this. So this was a 30-year at 3.5%. Let's look at, so we want to keep track of, let's look at this. Number of payments, payment per period. Okay, so let's look at this in isolation. If we were to move this up to 7%, so you can kind of look at it stepwise. So if this goes up to 7%, okay, so the payment at the 3.5 was $1,616. At 7%, it jumps up to almost $2,400, and you're paying a lot more in interest. So let's this to Cleveland. Okay, so you can see the interest paid has over doubled with the doubling of the interest rate over that 30 period time. And now we'll even add just 5 years at first. Let's say 35 years. And notice that I didn't even have this chart go out that far. Oh. We'll go all the way up to 480. Okay, so we've now extended it to 420 payments. Let's just keep that. So you can see from the 7% just going from here to here, extending it 5 years. Yeah, I mean, it does. Here, we'll look at differences here. So we've got an extra 60 payments or 5 years. Our payment per period has gone down about 95 bucks. Okay, so we've extended the payment by 5 years. Our payment has only gone down $95 a month. And the interest paid now over that course of the loan has gone up $103. I mean, so you really got to ask yourself, like, how much do you really, does that $95 really, like, is that the difference between you being in the house and out of the house? Like, that's a lot of interest if you hold on for that whole period. And plus, if you were to get a higher number of years, this would not be a static number. This would go up, right? Because if you're lending your money out, you want a higher rate of return. So let's say for every 5 years, it goes up. Well, let's just here. Let's see what it does. So 7.25%. What does that look like? So we've kept the years the same, but we've just increased that 25 basis points. Okay, so and this is just the stepwise difference. So now from here to here, we have payments per period. So the payment has gone up about $63 and total interest paid has gone up $26,000. So here, let's compare it. We'll put this in, let's say this is our base case. So we'll do an absolute difference. This minus this column. So this is always being compared to that column D. Okay, so extending it 5 years, you're going to be paying a little bit higher interest. And this is just assuming it's 25 basis points or 0.25%. So with that, you're lowering your monthly payment by $32, but your total interest paid over 35 years has increased by $130,000. So, I mean, you kind of gotta ask yourself, we're getting down to these periods here. So let's now go up to 7.5%. See how that affects it. And if it did go up a full 0.5%, I don't know if it would. I'm not sure how they underwrite these, and it depends on your credit, obviously, whatever. But if it went up a 0.5%, your payment per period has now actually gone up in total terms from this almost $2,400 to now it's like $2,427. So at that point, the payment per month is not even lower. That doesn't seem like a good deal, and you're paying way more in interest. So let's see now. Let's go to 40 years. Just look at how much in this table. Of the 2369, the first couple of years, I mean, it's like each month is $2,250 in interest. So let's just go just so you can see if you did a 15 year. Sorry, you can see that the interest is high in the beginning, but it drops much more rapidly. So you're paying off $1,000 in interest each month. Whereas if you go to the 30, you're only paying like, $267, $35, $177 a month. That's all you're really putting away and saving. And you're paying this amount of interest just to participate in that home. So if we go to 40, is that what? So now let's go to 40, see what that looks like. So now we're making 480 payments, so that's another 60 payments. And you can see going from 35 to 40, our payments dropped $58. But once again, there's a big jump in the amount of interest we're paying over the period. So, and so going from this 30 to the 40, even at a higher rate, your payment's gone down, $25 a month. So, and that's also assuming that the interest rate wouldn't go up again a little bit. So if the interest rate did go up to, let's do another quarter or 25 basis points, 7.75. See what that does. So you can see going from the 30-year to the now 40-year higher interest rate, we're now actually paying more per month, and we're getting just walloped on the interest. $300,000 over that 40 years. So let that sink in, and it's not just about whether you can make the monthly payment. So think about what you're paying in interest versus you're paying in principal. And see if the lower amount, obviously, the more principal you're paying. That's this orange line, the higher that is. And the quicker your principal will exceed the interest. So if you put it to 20, you can see it's kind of extended out, and how that orange curve keeps getting extended out. And you're paying a real lot of interest. And I'm not going to get into the tax things along deducting interest on a home, or if that's allowed and where you are, but that could be another thing to think about and consult an accountant about how that fits into your personal strategy, your personal picture. But yeah, I hope you enjoyed this episode. Hopefully you got some value. You hopefully understood a little bit about how the interest rates and extending the years to pay it back affect not only the monthly payment, but the total interest you're paying over the course of that loan. And I will talk to you in the next episode.